on out there. So without further ado, I am going to introduce our two presenters today, Chad Snyder and Tyler Trahant with Dominus Commercial. Take it away, Chad.
Sounds good. Okay, share the screen here. Good morning, everybody. Happy Wednesday, hump day. Good to be here. Share my screen. Everybody see it all right?
Yes.
Fantastic. My name is Chad Snyder. I am the Managing Director of Dominus Commercial Real Estate here in Fort Worth. My partner, Tyler Trahant, Senior Vice President of Dominus Commercial over here. We are collectively the Argus North Texas Storage Affiliates. Argus is a collection of independent brokerages that specialize in self-storage brokerage. And we are pleased and honored to give the Dallas-Fort Worth market update here. Should be tailored more towards Dallas, but the DFW market kind of goes hand in hand. So without further ado, let's jump in. In discussing what we wanted to go over here, we don't want to go through a whole lot of graphs and data points and things of that nature. What we really wanted to boil down to was what would I want to know if I'm a buyer, an owner, a seller, or an operator or manager of self-storage at this point in time. So we want to talk about three specific discussion points: market conditions, rental rate trends, and the impact of COVID. And finally, we do have, what we did in this last couple of months here is we did a Argus market survey that really asks you, the owners, the buyers, the operators of self-storage in Texas, nationally, in Texas and nationally, about what your sentiment is. How do you feel about the market? Are you comfortable? Are you nervous about rates? Are you nervous about occupancy? Was your plan for development, did that hit the skids or things of that nature? We're happy to provide that, and I can give more detail on that at the end of this deal. And in this discussion here, what we wanted to do is give context.
It was lowercase
today, as well as what the market's been doing in recent years, in an effort to gauge how we're doing in 2020, closing out 2020 and into 2021. So, what does the new development pipeline look like? A lot of numbers there, but by and large, how does this compare with previous years? Well, on average, the last 5 years or so, we've been delivering somewhere around 2.5 million, maybe a little bit more, square foot in the DFW market in East Texas, East and Central Texas markets. That does not include Austin, but places like Temple and Killeen and into Tyler and Longview. This data was taken from Yardi Matrix. It's a pretty thorough database for us here. But what are we delivering now? Basically, we are down about 16% over that 5-year average for 2020. And why is that? Well, we saw development slowing in early 2020 before COVID hit us. We thought that COVID would exacerbate that, and it did. A lot of people just decided to say, I'm going to hit the pause right now, or I'm not going to do anything. But in the last couple of months, a lot of our conversations are about developments getting back off the pipe or back online and ready to go. So, So what has been the impact of this new development and a pandemic had on rental rates and occupancies? Well, occupancies has maintained a pretty high level here, but rental rates have had to adapt. In April, as we'll see in the next slide from now, we lowered rental rates to kind of hedge and to bolster our occupancy so that we could withstand the unknown that we were going through back in April, May, and June. Since then, what is really interesting is rental rates have actually started to return back to pre-COVID levels. As you can see here, and we'll show another graph in the next slide that gives some more context to it. But rental rates, we dropped, and they're actually coming back, and in some places are actually pushing further than where they were before COVID. That's a great sign for market recovery. In fact, some operators, both national and local, have said that they've gone ahead and pushed rates about 15 to 18% more than they were pre-COVID to try to recapture that revenue loss from the second quarter of this year. But all said, it's a great thing to be able to see our rates coming back up and even surpassing where we thought they might be. So as you can see, 10 by 10, 10 by 20 is the most common unit sizes. That's why we picked those. But by and large, our forecasts indicate that we're going to be doing a whole lot better. So let's talk about our local economy and our jobs. You may recall, and this was really, kind of me biting a humble pill, but in March, I wrote an article for the TSSA magazine, kind of prognosticating what the future was going to be. Clearly, I was wrong, no doubt about that. But the fundamentals that I did highlight in that article about Texas and the DFW market specifically, they still ring true. We have a very solid population growth. We continue to get a solid job migration growth and solid job and wage growth in the North Texas market. That is anticipated to continue to go on. And what I want to point out on the third bullet point in this slide specifically is CoStar came out with an article back in, I think, early August or so. And it discussed the amount of jobs that have actually returned back to the marketplace in the last couple of months since the job losses of over 400,000 in March and April. It represents a 42% increase in job recovery. That's fantastic news. It's wonderful to be able to see those numbers come back. And I know if you compare them with what we've done year over year, it's not an accurate comparison, but it's a great step to getting us back to where we were once before. And when we go and we talk about the jobs and recovery, we're talking about storage being developed. Well, what does the transaction market look like? And that's closely tied into the financing market here. By and large, if you recall, in late March, the CMBS markets flat out just said we're going to sit on the sideline for all intents and purposes. And that had a pretty significant impact on anybody that had a deal under contract that was going to go after CMBS debt, or even somebody that wasn't under contract with CMBS, but maybe more of traditional lending. Transactions pretty much stopped in Q2 because we were trying to figure out what are the rates going to look like. The banks were trying to figure out not only the SBA PPP plan, how to get all that money out there, but then they also had to figure out how to hedge their exposure to other asset classes, most notably retail and hospitality. So what came of that is kind of an ever-shifting financing market. Ultimately, it depends on the credibility of the buyer and what they're wanting to do. But by and large, what we're saying to people is be prepared. If you were going to put down 20, 25% down on a property, be prepared to have that conversation with your lender about something where it might be like 30, 35% equity. And be prepared for longer closing periods. I can specifically speak to a property right now that we've been waiting on an appraisal to come back for over 2 months. Now, that's not an everyday occurrence, but that is something that is an issue. How have the transactions been? Well, when you can get it financed and you can get your third parties done in an appropriate amount of time, we typically are seeing cap rate levels come back to the levels that were before COVID. Now, it varies in what that number looks like based on the quality of the asset, the location, and things of that nature. But ultimately, we're still saying somewhere between 5 and call it 7.5% cap rates on most transactions in the DFW market. Again, touching back on the financing market, while we anticipate longer closing periods, third-party travel has been a challenge for some transactions. Financing delays, let's say you have to go to multiple lenders in order to get somebody to say, absolutely, we're your guy. Other things that are, you wouldn't see normally pop up. I had a closing scheduled 1 week, and the purchaser couldn't come to the table because he transacted COVID that day. So we had to push closing and do a remote one. But that's kind of the day and age. We have to adapt and move forward there. There has been a conversation about lease-up acquisitions lately. By and large, for it to make sense, most properties, if you're going to buy it, buyer's going to look at it about 150 to 200 basis points above a traditional cap rate upon a stabilized occupancy, probably around 80%. So if you were going to buy a fully leased up newer facility, let's say it's 5.5 cap, If this was in a lease up, early lease up or a C of O type deal, you're probably looking at somewhere around a 7.5 cap price point to begin with. Now, we might see more of that coming across, but that hasn't been in the market for a long time. We put it up there because we've had conversations in the last couple of weeks about that. So again, I pointed out to you before, we have the National Argus and the Texas Argus Market Survey available for anybody who wants it. Again, this hopefully gets context into what other operators and owners are doing, their overall sentiment in the market, and their plans for the future. That said, I'll conclude with this. My take on the overall market and the economy here is, we're not out of the woods yet. We're still dealing with a lot, but we sure are making a lot of great strides, especially in DFW, to come back stronger in 2021. Thanks so much. Appreciate it.